Hey, welcome back to Two Super Guys Trade Stocks. I'm Dylan.
And I'm Vinny. If you're seeing this word come up again, it's called stagflation. We're going to talk a little bit about it in this video. It's a topic that's kind of reemerged and it's on the trend. We're going to talk about why that is and why it might matter.
Yeah. I got lost. Inflation is bad.
Two stupid guys trade stocks.
Yeah. Of course, coupled here with old wheelbarrow cash guy too. This is from the Weimar Republic. This isn't quite stagflation. This is just hyperinflation. And a little law graph here in the back. Think about the fact that this was what the consumer price index did in actual Germany during the 1920s. And this is a log scale, right? So each kind of row here is times 10. Yeah, that's ridiculous.
I mean,
Yeah,
it would be kind of cool to have like $100 billion, though. I mean, it
yeah.
didn't. It didn't mean a lot, but still pretty cool.
Yeah, exactly. I mean, $100 billion would probably buy you like 3 loaves of bread at that point, but pretty ridiculous. So this term stagflation, if you actually look at this Google trend data, it's something we haven't, I haven't looked at in a while, but I had seen a couple articles about it. I was curious, like, is it trending? Is that something that people are talking about again? So basically, this keyword here, stagflation, is trending at the highest level it has in the last year. It's interesting.
Okay, that makes sense because we were expected to have a little drop, more possible rate cuts this year, and I'm thinking maybe one. I still don't think we're gonna have a rate hike. I still think that's unlikely, but
Yeah.
possible.
In particular, there was some economic news this week that kind of brought it back into, I want to say here, like relevancy. So, stagflation is when you have an economic cycle characterized by slow growth, high unemployment, and high inflation. All right. So, over the last kind of 2 years or so, we've had high inflation coming down, but still high, and we've had high growth. Right. So, we haven't had the slowing growth, and unemployment's been at an all-time low, like one of the best job markets in,
Yeah,
in decades.
didn't really make
Job
sense.
markets quoted the same this week. So we've had, basically only one of the three characteristics here, but now we're starting to get news reports that we may have two of the three characteristics. All right. So GDP data came out, and gross domestic product. That's the total output of the an economy, and the number came out light this week. It was 1.6% for the first quarter of 2024. All right. I mean, look at this graph. Right, the line goes down. Durr. I feel like that's how it works.
Yeah. Okay. All right.
Yeah. So, and it wasn't really expected by economists, right? So you're seeing headlines like this, first quarter GDP slows more than expected, inflation keeps rising. Persisting inflation that's high, now slowing economic output, right? So
The
right
the
now we're looking
weirdest
like two out of those
aspect
three criteria.
the weirdest aspect is the unemployment rate.
Yeah.
It's been very, very resiliently low. I know that it went up a little bit, but the little bit is relative. It barely went up. It's,
Yeah.
I mean, we're doing great.
No, I agree. Like I said, there was an interview. I don't think I put this slide in here, but I'm talking about Janet Yellen saying it was like the best job market in 15 years or something like that. Absolutely phenomenal. Um, But basically a 3.4% increase in the fourth quarter of 2024, which is a pretty sizable number, but less than half of that in the first quarter of this year. So a pretty significant drop off from the fourth quarter to the first quarter. Now that's makes sense, right? Seasonally, fourth quarter is pretty
Yeah,
strong, right?
that's what.
Is
Yeah,
that your
okay,
point?
that's what I was gonna say. All right.
Yeah. So they were looking for a deceleration, but they were looking for a deceleration to 2.4%. So this isn't like a slight miss, right? 2.4% versus 1.6 is a pretty significant gap. This isn't by 0.1%, like we see some data points sometimes. Um, Yet when we had PCE data come out this week, it's been persistent. All right. So PCE data is the Federal Reserve's preferred inflation gauge. Personal consumption expenditure was still 2.8%. Right. So we have inflation being persistent, come down a lot, but still being persistent. And now we have slowing economic output. All right. So you do have two out of the three legs here, so to speak, of a stagflation scenario, which is a really crappy scenario to end up in, which is why people are paying attention and why that word is on the trend as far as Google queries and searches.
If
Um,
um if we do hit stagflation, it is more evidence that Jerome Powell was a badass because he was getting calls from Yellen and a couple other prominent economic figures like before he did like three more rate hikes to not do it or he's going to crash the American economy. He's like, no, that's not correct. We're going to do more rate
I mean,
hikes.
It's a tough pickle to be in, though, right? Because if
It
you're in
is, but
stagflation, you have inflation still persisting,
true,
and you have the economic output slowing.
true. But
So,
imagine what would happen had he not done 3 more rate hikes. We'd be in a much worse situation,
I
much
mean,
worse.
potentially, I guess you could say it would have been more persistent. I'm thinking about like what are their tools in order to fix that? Because if we enter a stagflation period, they would typically want to stimulate the economy in order to break that low economic output.
Mhm.
However, if they do that, now you're looking at making inflation go parabolic and looking at something closer to that hyperinflation ridiculous chart, right? That's the risk at that point.
True. I don't think we're gonna hit that hyperinflation chart. That's some
No,
some craziness.
no. Yeah, but like that's something that will be very much on their mind. So this is another kind of worrying trend here, which is interesting and definitely observe something I observe in my normal day to day life. Personal spending is still up 0.8% for the month. People are still out there. I went to dinner last night. It was a 40-minute wait for a local
Hmm.
restaurant. Granted,
Yeah,
it was Friday night, but people are
you would have
still
no
spending
idea.
money. Yeah, and personal savings rate down to 3.2%, down 0.4% from February, and 2 points from a year ago. So people are definitely using their spending to sustain this elevated, kind of buying pressure.
I think as
Right?
long as people can get more credit cards, we'll just last a lot longer. We should be fine.
Yeah, absolutely. Um, and then personal income increased 0.5%. So people, spending rose higher than income. 0.5%, expectation is it was in line with their expectations, but it's still a little bit larger number than I would personally like to be seeing right now because you risk that price earnings spiral. So they need to keep wages under control a little bit, and we already talked about this.
Right.
So, as far as the other leg of stagflation that we're still missing here, would be a high unemployment, and unemployment is still remarkably low, 3.8% here. Powell has talked about under other indicators of job market softening a little bit, how quits are down. The ratios come more into balance. I think it was most recently like 1.6 jobs or something like that available per available workers, rather than like we were over 2 at one point.
Right.
So it's much better balance, but it's still a very tight labor market. Extremely tight. Yeah.
That is fair. I would assume that would change at some point.
Mhm.
Here is a TLT, just because we're talking about inflation. Obviously, I'm gonna bring up TLT. I have been selling covered calls at 90.
Okay.
Because this is, I should put up a different chart. I have a resistance and a support 87 through 90. So I would have to zoom out a lot more on this chart to 10 years ago, but the 87 levels very, very strong.
Uh-huh.
So I've been trying to bounce between 87 and 90 on puts and calls, but unfortunately my calls have not been assigned it. Oh, I guess fortunately. I should say unfortunately, because I'm just
Mm.
collecting free premium. But it's working out pretty good because
Nice.
it's like $40 every like 2 weeks per
Yeah. Okay.
contract.
So you're doing
It's not bad.
2 week expirations.
Yep.
I was going to say this trend doesn't look like it goes back very far. You're talking about like maybe April 10th or so is when it entered this little channel potentially.
Yeah.
So it hasn't been there very long. That's like not even well developed to me as far as being based upon this little graph, a strong like support and resistance kind of box.
You have to. I should have. I put it. I put the wrong graph up. You have to zoom out quite a bit to
Okay.
10 years ago. Unfortunately, that's my bad. I should have put that up. It's more 87 is a very, very strong support. I'm kind of trying to get premium for covered calls and get caught so that I can do puts at a much lower number because I would expect this to go to 87 and possibly break. So
Yeah. Yeah, yeah. I mean, I thought the kind of the day of low 80s on TLT were behind us, but maybe not. Now there's I think it was Bank of America to call for the first rate cut to not be until March of 2025.
I still think there's going to be one this year, but I think that would be reasonable. I don't think there's going to be a rate hike. I don't think our economy can support it. I know a lot of people are calling for it, but I don't think that's going to happen, especially with housing where it's at. I just don't
Mm,
see that happening. So
I don't know. Home prices are still going up despite the elevated mortgage rates, which is bananas.
just BlackRock's just buying homes left and right, man. All
Yeah.
right, guys, let us know what you think.
Catch you next one.